So Bismillah ar-Rahman ar-Rahim. This is a revision for chapter 18. So chapter 18 talks about notes. Notes are long-term liabilities, meaning that the company will take a loan or amount of money in exchange of giving a paper which is a note. As we said, long-term meaning that it's more than 1 year. It can be for 3 years, 4 years, 5 years. As it's a long term, we are not paying only the debt itself, the amount of debt or amount borrowed. We are paying the amount borrowed, and we will be also paying an interest, as it's a long-term liability or it's a long-term debt on the company itself. So in this case, we have multiple steps in this chapter. First step that we are going to do, we are going to calculate or calculate the present value of the bond itself or of the note itself, and we will do that using this table. First of all, we have the principal of the note. This is the amount written in the note itself or on the bond itself, and the interest amount. So let's say that the company, for example, have borrowed a note payable or bond payable for $600,000. So and the interest was, we have the market interest and we have the stated interest on the note. So let's say that the stated interest on the note was 5%. This is the stated, that means it's written on the note itself, and we have it on the market itself. It was 7%. Okay, 7% is the market rate, market interest rate, and 5% is the stated or written rate on the bond itself. So in this case, first step that we have to calculate the present value of the note itself. We will do it using this table. First, we will use the stated rate on the note itself, which is the 5%. So 5% times the borrowed amount, which we said in this case it was 600,000, times the factor. The factor for the interest rate, we will take it from table 4 because it's multiple payments during the years. So depending, let's say that this loan or this bond was issued for, let's say, 5 years, and the interest is annual interest, meaning it's paid by year. So we will use table number 4 for the interest itself to find the factor. Let me show you a factor. Okay, this is table number 4. As we said, the loan or the note is for 5 years, 5% interest rate or stated rate, and 7% market rate. And we said that is annual payments. In this case, as it's annual payments, that means the payments will be 5 payments. So here we will go to number 5. So the column will be for the payments or the number of payments. If it's annual, we will take the same number. If it's semi-annual, we will be multiplying the number of payments by 2. If it's semi-annual, we will multiply it by 2. So it will be 10. If it's annual, as it's in this case, it will stay 5 as it is. Okay, for this one, for the interest rate, we will use the market interest rate. The market interest rate, to take it from the tables. So the market interest rate here, it's 7%. And is it annual? If it's annual, we will leave it as it is. If it's semi-annual, we will divide it by 2. Okay, so in this case, it's annual. We will go to the 7%. From 7% here, and the 5 payments. This is the factor that we are going to use for the interest, which is 4.10020. Okay, we will take the factor here and use it in our example. times the factor from table 4, and again table 4 is for the interest only, which we said it was 4.10020, and we will have here the present value for the interest. Then again we'll finish the same thing for the principal or the amount borrowed, which is here in this case 600,000 times the factor from table 2. The principal, we are paying the principal amount on the note one time only after the 5 years. That's why we are using table 2. Again, you will go to table 2, the same process. You will go to the 7%, 5 payments, and you will find the factor. Once you have both factors, you'll have to multiply the interest rate times the factor and the borrowed amount times the factor. You will have here the amount. We will add the interest amount to the principal amount, and then the result will be the present value or the price of this bond. Okay, so this is step number 1 to calculate the present value of the bond. Step number 2, we need to write the entry for issuing this bond. The entry will be as follows: from cash discounted on bonds to bonds payable. Okay, on bonds payable, we will write the principal amount, which is stated on the bond itself and given directly on the question. In front of the cash, we will write the result here, the present value from the table. It will be in front of the cash. The difference between both amounts will be the discounted on bonds, meaning that bond payable minus the cash will equal to the discount on bonds. This is step number 2 to write the journal entry for issuing the bond itself. Step number 3, we will ask you to write the adjustment entry for the interest. As we are paying an interest every year, you are required to do the entry for the interest every year. So the entry itself will be from interest expense to cash, and of course the difference between both will be discounted on bond payable. How are we getting these numbers? We have to do something called the amortization schedule. To get the numbers for the journal entries of the interest, we will have to do the amortization schedule. The amortization schedule will be as follows. Again, here the first column will be the number of payments. This will be the number of payments. So in our example, it's 5 years, annual payments, so it's going to be 5 payments. For the second column, it's the cash interest. The cash interest here the cash interest here is the interest, is the stated interest on the bond times the principal or the amount borrowed. So in our example, it was 5%. The borrowed amount was 600,000. Whatever this amount is, it will be fixed directly. Okay, sorry. So for example here 600,000 times 5% will equal 30,000. This 30,000 will stay the same in all payments. So this number will not change for all payments here. Okay, going to the second column, which is the effective interest. The effective interest is the market interest times the outstanding balance. This one will change for every payment because the outstanding balance for the first one, for the first payment, will be the present value of the bond. So the market percentage here, for example, in our example was 7%, and the calculated here present value was 579,377. So this was 579,377. So this will be the first outstanding balance. So the 7% here times the 579,000 377. So for the first payment, it's going to be the present value only for the first payment. Then the third column will be the increase in the balance, which is the discount reduction. It will be the cash interest minus the effective interest rate. It will be here the cash interest minus the effective interest rate will equal the discount reduction. And of course, in the table itself, as we said, the last column, we will start with the present value and then add the amount or the discount reduction to have the second outstanding balance. And again, we'll continue to the last payment until we reach to the principal amount. Okay, in the exam itself, of course, I will not ask you to do the whole payments. I'm going to ask you to do 2 payments only or 2 years only, so you know the process itself. Okay, when we want to do, yeah, tell me
The
please.
table will be given in the questions in the exam.
Yes, the table will be given. The table will be given. Yes. Okay. Right. The most important thing that we are doing this table to amortize the reduction of the cost or the discount on the bond itself, and to do the interest entry. So what's really important for me here is you have to know that the first column, the cash, will be written in the cash part. So whatever this amount here will be in front of the cash, and let me write it here. So this is the cash amount, and for the effective interest, it will be the interest expense. I'll write it here. This is the interest expense. So if I ask you to do, for example, the entry for the first year, the cash will be taken from here and the interest expense will be taken from this cell. And the discount on bonds will be the discount reduction. So this will be the discount on bonds payable. So for example, just to take from the numbers from this exercise or from this example here, so the interest expense here, it will be the effective interest 278, the cash will be 18,000, and the reduction will be the 278. So this is how we are going to use the numbers from the table itself. Okay, So this is the amortization schedule. Next step is how does it show in the balance sheet or the financial position? How does this bond show in the balance sheet by the end of each year? Okay, first we have to start with the bond payable in the liability part. Of course, under the liability, you will write first the bond payable. This is the main thing here with the total amount or the principal amount of the bond itself. You will less or minus the whole discount from the first entry from the issuing entry here. This is the total amount of the discount. So this will be deducted from the bond on the balance sheet. Okay. Less the bond discount. Then get the result. By every payment, with every payment, you have to add the amortization discount. So if we have one payment, you will add only the amortization from the first payment. If we have two payments, you will add the amortization payment or the second one also. It will be depending on the question itself. After first payment or second payment, I will be asking you to do how this bond show in the balance sheet. So again, first step, you will put the bond payable with the principal amount. Then you will deduct the total amount of the discount. And if there is any payment, you will add the discount amortization of the payment. If it's only one payment, you will add one number. If it's two payments, you will add both numbers. This is on the balance sheet itself. So step number 6, how it will show in the income statement. In the income statement, we only show the interest expense of each year. Again, if it's only one, if I'm asking you to do after 1 year, after one payment, you will show the interest expense of this year only, and that's it. So for example, the interest expense here was, in this example, it was 20,278. This is what will show in the income statement. Last step here, after the 5 years, the 5 years are done, it's finished, and then we have the payment day or the maturity date. You have to pay the principal of the bond itself, and this will be as follow: from bond payable to the cash with the principal amount, which was in our original example, 600,000 to 600,000. Okay, do you have any question on the chapter before I start the example? It's okay. Shall I start the example itself? Or the practice?
Yeah, you can start.
Okay. I chose this question 14.9 because I found it comprehensive to have everything that we need. So let's go. Okay, it's okay. Okay,
Yeah.
this company, issued a 6% bond. So the percentage or the stated percent on the bond was 6% on January 1st, 2016, with a face amount of 600,000. So this is the face amount, the principal amount, or the borrowed amount, it's the same. The market yield of this bond, similar risk and maturity, was 7%. So this is the market interest rate. Okay, the bond mature at December 31st. That means it's 4 years. And the interest is paid semi-annually on June 30 and on December 31st. So before we start, as it's semi-annually, I'll start from the beginning, knowing how many payments, first number of payments. It's stated that it's 4 years, and as it is semi-annually, the 4 years start, it's 4 years, And as it is semi-annually, the 4 years times 2, that means we have 8 payments. And for the interest rates, for the market interest rate, just write it here. Market interest rate, it's 7% divided by 2 because it's semi-annually. So the market rate right now is 3.5. And for the stated rate, I'll just write it here, stated rate, it's 6%, also divided by 2 because this is semi-annually. That means the stated rate on the bond will be 3%. Okay, so this step we have to do it in the beginning of the question itself. Then again, the requirements. First, determine the price or the present value of the bond at January 1st, 2016. So to determine the present value of the bond, we need to present the table or prepare the table of the interest and the principal and find the factors from table 2 and table 4. So we will prepare the table as follow. We have the interest rate and the principal. First, I'll take the interest rate. The interest rate was in the question. The stated one was 6, and then we divided by 2. So it will be 3% times the principal or the borrowed amount, which is 600,000. That means the interest rate will be 18,000. The principal amount will stay as it is, 600,000. And then we have to find the factors from the tables. Okay, so for the interest rate, I'll go to the ordinary tables. Okay, and we said that for the principal, we will use table 2. We're using table 2. The number of payments was 8 payments, 4 years semi-annual, that means 8 payments. And the market rate was 3.5. 3.5 was here. So the factor here for the principal will be 0.75941. And for the interest rate, again, we are using the 8 payments, and the market rate here is 3.5. So for the interest rate, the principal will be, the factor will be 6.87369. So we find the factors from the tables. We'll go back to our question and multiply the numbers with the factors. As we found it on the tables, the interest rate from table 4 and the principal from table 2, and then we'll multiply the numbers with the factors and then add both numbers to get the present value or the price for the bond. So question number 2. Question number 2, prepare the journal entry to record the issuance of the bond itself. The issuance for the bonds, we'll do it as followed. First, we will take the present value. The present value is the cash received. So the cash received will be the present value from the previous table. And the bond payable will be with the principal amount. Difference between both, 600,000 minus the 579,377 will be the discount on bonds, which is 20,623. Do you have any question here? Shall I continue? Any questions? It's okay. Okay, perfect. Question number 3, prepare the amortization schedule to determine the interest and the effective rate of each period. So we will prepare the amortization table. Amortization table, as I explained before, it's as followed. First, the first column will be the number of payments. As we have 4 years semi-annually, it will be 8 payments. The second column will be the cash interest. It will be the stated interest times the principal, and we said this amount will stay the same for all payments. For the second one, it will be the effective interest, the market interest rate. This one is the stated interest rate, and this is the market interest rate times the outstanding balance. For the first payment only, we will use the present value. Take the present value as it is and use it for the first payment. We will get the effective interest rate. Then we will deduct the effective interest rate minus the cash interest. That will equal the discount reduction. Again, we will add the outstanding balance plus the discount reduction. It will equal the next outstanding balance for the second period. And for the second period, we will take the outstanding balance here times the market rate. Again, we will have the effective interest minus the cash interest. We will get the reduction of the discount. Then the next outstanding balance plus the reduction of the discount will equal the next outstanding balance for the third payment or third period of time. Okay, any question on the amortization table? How do we do the amortization table? The main principle or the main purpose of the amortization table that we build. The main principle or the main purpose of the amortization table that we start with the present value and we will finish with the principal of the bond. Okay, again, the importance of our use for the amortization table, that to do the entry, the interest entry, this is the cash, this is the interest expense, and this will be the reduction and the discount itself. So question number 4, if I'm not wrong, prepare the journal entry to record the interest for the first payment. The interest for the first payment, again, we are taking the numbers from the amortization table. So the cash will be 18,000. The interest expense will be 20,278. And the difference between both will be the discount, which is 2,278. And the entry will be as follow: interest expense and the cash will be the 18,000, and the difference between both is the discount on bonds payable. Okay, and if he asks also for the next period or in December, it will be the same thing. We will take all the numbered interest expense to discount on bonds payable and cash, and we will take the number from the amortization table for the second period of time, which is the second payment here, 18,358, and this is the discount amount. It depends on which entry they will ask you for, sorry, which period of time they will ask you in the exam itself. Okay, question. Do you have any question or shall I continue? Okay, okay. Yes, any question? Okay, no questions. Okay, question number, I think this is 5 or 6. 1, 2, 3, 4, 5. Okay, question number 5. How any amount related to this bond will show in the statement of the financial position by the end of the year? By the end of the year, we have here 2 payments. So how will it show in the statement of financial position? Financial position will show on the liability side because the bond here is a liability. So first of all, we will show the bond itself with the principal amount. The principal amount is 600,000 minus the total discount from the first entry, which is here the discount on the bonds. And then we will add any reduction of the discount. So we said after the first year, by the end of the first year, so we have 2 payments. So we will add here 2 discount reduction to the amount on the balance sheet. So it will show as follow. First, as under the liability part, there will be bond payable with the principal, which is 600,000, minus the total of the discount from the first entry of issuing the bond. We will get the present value or the price of the bond. Then we will add any reduction of the discount by the number of payments, as we have here 2 payments on June, the first payment, and in December, the second payment. We will add both payments here as a reduction of the discount. We will get the amount of the bond on the financial position. I think then we have question number 7. How will it show in the income statement? In the income statement, we only show the interest expense. The interest expense. The interest expense by this year, or by the end of this year, we have 2 interest expense. Again, from the amortization table, we have paid 2 interest expense. The first one for the first payment in June. This is June. And the second payment was on December. So we have 2 expenses here, 2 interest expense, which will be recorded in the statement, and the financial, in the income statement. In the income statement. So this is how it will show in the income statement as interest expense. As interest expense. Our last question is, how does it show, prepare the journal entry for the maturity of this bond at 31st December 2019. At maturity, we are paying the full amount, the 600,000, the principal amount of this bond, from bond payable to cash. We are paying full amount of the bond from bond payable to cash.